Welcome back to my mentorship series. This is episode 9. We're going to be covering higher time frame analysis. So most of you guys know I am a scalper. I take entries on the 1 minute and the 30 second, but that doesn't mean I neglect the higher time frames, right? So I always have up a total of 8 time frames simultaneously, spanning as high as the daily all the way down to, of course, the 30 second, right? So I go daily, 4 hour, 1 hour, 15 minute, 5 minute. Then on some other charts, I have time frames like the weekly, like the 12 hour, just everything I sort of need to have that higher time frame context and narrative, right? It's like having a map. I want to understand where I am on the entire map and not just on that one focal point. So higher time frame analysis for me encompasses a few things. Number one, seasonality. By seasonality, I mean aggregated data over the last 20 years or so, showing what NQ, because that's what we're trading, generally does on a monthly basis, right? How it fluctuates throughout every month. After that, we'll look at manipulation and weekly profiles, because we understand that if we're bullish, first we're going to want to see price come down, right? Manipulate, allowing smart money to accumulate at favorable prices. Then we'll move on to liquidity, basic highs and lows. Obviously, this is the NASDAQ 100 index, so year over year, it generally produces a positive return. But we'll look at liquidity on more fractal lower timeframes like the daily, like we see here. Then we're going to look at PD array reactions, right? What are we respecting? What are we rejecting? And finally, we'll cover inversions. What are we invalidating? If we have a bearish weekly FEG and we close above it, well, that's even more context for a bullish bias and how we sort of blend all of that together. So if you guys don't know already, I've kept a journal for the last 3 years in which every single week I create a weekly outlook, right? I create a weekly bias. And then, of course, every day I create a daily bias and a pre-market bias. All of that I share with you guys in the Discord. Right, so this spans, every single week, every single day. I'm formulating some sort of bias. Again, even though I am executing on such micro timeframes, that doesn't mean I'm not paying attention to these higher timeframes. I think the more understanding, the more context we have, the stronger our edge is, and we just have those slight probabilities working in our favor. If I'm bullish on the weekly, I'm bullish on the daily, and I'm bullish on the New York session, well, I understand that longs might just be where my edge shines the best. So I'm going to be looking for long entries as opposed to shorts, right? So again, not necessary and something that a lot of people will overlook, but to be a full-time trader, right, if that's your goal, you really do need to be paying attention to every small detail. So number one, let's get into it. Seasonality. There's a free website. It's called equityclock.com, in which you can access aggregated data for all sorts of assets, right? Commodities, oil, indices, all different futures contracts. And specifically, looking at the NASDAQ 100 futures, we can see that this is how NQ performs on a monthly basis and how those months are broken down. So if we zoom in a bit more, we're currently in January of 2026. So this is 2005 to about 2025, how January has performed on average, right? We see a bit of a spike as the new year opens up, and then we see chop and a slight decline, just ahead of February's bullish month. So if I'm coming into, the first or second week of January, I might tend to have a more bullish bias as long as my technical analysis also aligns with the seasonality, right? And if TA is a bit choppy, like we've actually seen over here, right? This has been January so far, quite a bit of chop. Well, that lines up perfectly, with these last few weeks here in January. Not by coincidence, right? This is generally how price moves on these higher time frames. So equityclock.com, right? Just type in equityclock.com. It's 100% free. You don't even need a membership or any login. And you can view all of this, again, for absolutely free. So that's what I refer to when I'm talking about seasonality, right? And that can be further broken down into the daily and so on. Because again, if we are bullish on the week, let's say seasonality tells us that this is typically a bullish week, and technical analysis also aligns with that narrative. Well, first, I'm going to be expecting a bit of bearishness to start out the week, right? Monday, Tuesday, maybe we, see a slight decline, right? So we understand that manipulation is fractal across all time frames. If I'm, expecting manipulation on the 15-minute candle, well, I'm going to apply that same logic to the weekly candle. And that brings us to our second point here, manipulation and weekly profiles. So if any of you guys are ICT purists, you've definitely heard of weekly profiles and manipulation in conjunction, right? And what does that really mean? Again, it refers back to that concept of AMD. So if you look at the bottom right, if we're bullish on the week, I'm not just expecting price to go straight up. First, I'm going to expect some manipulation lower, allowing smart money to accumulate, and then distribution to the upside. Vice versa, if I'm bearish on the week and I have all of these various reasons to be bearish, I'm not expecting price to go straight down. I'm first expecting some sort of manipulation. Now, this is a pretty textbook weekly profile. It's not always that direct. It's not always like Monday manipulates higher and then we sell off. Sometimes it could look something like this. Monday might, begin that downside distribution, but then we might see Tuesday spike up, right? And that forms our high of week, and then we see distribution to the downside. But generally, that first 40%, first 30% of the week is when we can expect some sort of manipulation on a week that tends to trend, again, based on that seasonality chart. So this is an example of a weekly profile, right? Accumulation Monday, maybe manipulation Tuesday, and then distribution Wednesday, Thursday, Friday for a bearish profile. And if you guys want to learn more about this is on YouTube for free. It's in ICT's core content. This is from 2022. So he covers a multitude of different weekly profiles, as you can see here, right? Plenty of weekly profiles. And then month 8, some more weekly profiles being broken down. So all of these various manipulation tactics and seasonality charts go into establishing my weekly bias, right? And then that helps me on my daily bias as well. Where are we within the week? Have we started to see some of that accumulation, or are we already seeing manipulation right at the open of the week? So on and so forth, right? Of course, liquidity is a huge factor here. So let's just look at this weekly chart. Okay, this is our current weekly chart. As you can see, January has seen a bit of accumulation to kick off the year. Maybe we see new all-time highs later in the quarter, right? February or March. But so far, we're pretty on par with seasonality, quite a bit of chop. Where is liquidity? Well, not only do we have all-time high up here, but we also have some relative highs here, which are better seen on the right on this daily chart. So we've had this set of equal highs for quite some time now. We formed a fresh bearish FEG here. Price never actually retraced up into it. So this is a form of really strong engineered buy-side liquidity. This is something I've had my eyes on for quite a while. So we have 1, 2, 3, and then a fourth lower high here. So this is relative equal highs, right? This is higher time frame liquidity. A ton of buy stops are beginning to accumulate up here. Eventually, without a doubt in my mind, we will break these highs. It's just about aligning that timing. So perhaps on a really bullish week, according to my seasonality chart, if we get a bullish close the week before, I'm going to expect these highs to be our draw, right? Pulling us up. As you guys know, episode 5, draw, delivered, entry. Draw isn't always, the target for any position we're in. It's just sort of that magnet, that pull factor, right? Now, vice versa, looking at liquidity on the manipulation leg, what sort of lows are we sweeping? If I'm bullish, I definitely want to see some lows swept. And well, this week we've swept this daily low here. This was actually our low of year. Obviously, it's still early in the year, but nonetheless, this was our low of year, which was swept on this daily candle here. So we have absorbed some sell stops, right? This could be the last move we need before moving higher. While we're on the charts, let's also look at our FVGs and our order blocks. We don't just use these on the micro intraday timeframes. We also use all of these ICT PD arrays on higher timeframes. So something that stood out to me here on this weekly chart was this bullish weekly FVG here. This was formed in September of 2025. You see we stabbed into it once, made new all-time highs, came down, we stabbed into it again. Nice little 3 drives pattern here, but we are respecting this. Okay, we're also holding this weekly candle here, this body as a bullish order block, and we're seeing accumulation just above. So these are various bullish PD arrays that are holding us up. Now, if we move on to a daily chart over here, and these are generally the 4 higher time frames I have up. Sometimes I'll look at a monthly, but that is very higher time frame, right? That's a big macro. That's not super important for me. But if we look here on this daily chart, what FVGs are we respecting? What are we inversing? If we see here, this bullish FVG was inversed earlier this year, so this is no longer a factor for me, right? I don't have it marked out anymore. And we actually don't really have many imbalances on our daily chart, right? We do have some order blocks, right? We're seeing this last daily candle act as an order block here. Prices bounced out of it once. Perhaps we bounce out of it again. But I'm also seeing various bearish PD arrays holding. So if we look at this daily candle here as a bearish order block, we see prices rejected it quite a few times already. Okay, so we have this bearish order block defending these buy stops below all of this liquidity there, right? So these are various PD arrays that are being respected and rejected. But we can break that down even more and look at a 4-hour chart. So I'll blow this chart up here. right? What do we have going on? Obviously, we have a huge new week opening gap here. So this is another form of an imbalance, right, that the market is being drawn up toward. As you can see, we haven't really tapped back into it, but I'm sure later this week we will. But if we look a bit more to our left, we have a bullish 4-hour FVG holding here. We have a fresh 4-hour FVG down here. So this could act as a draw to the downside, right? Price wants to at least tap into it. We fully rebalanced this FVG. We've held it, but we haven't tapped this lower one whatsoever. Earlier today, we had formed a bearish 4-hour gap here that was actually inversed during the New York session. So, you know, that's no longer an obstacle for upside distribution. But we are holding these bullish PD arrays. So down in this area, you know, I'm not expecting smooth sailing to these lows from December. You know, I would expect a bit of a bounce at some of these PD arrays, and then at least a revisit to this new week opening gap, right? Using all of these various timeframes. So let's take a look at how we implement these concepts in real time and apply all of these factors to formulate our weekly and our daily bias, right? So this is an example from November 30th of last year, how I established a forward bias for that week. We were just coming out of this weekly close. So this is a weekly chart. This was the week of November 24th. We closed bullish, right? And you'll see some terminology that I'll elaborate on here in a second. But we closed bullish. So I was expecting more bullishness the next week, which aligned with our seasonality. We did end up getting that on this candle here, right? So that weekly bias played out perfectly. You see we did manipulate and form a bit of a lower wick, and then we distributed to the upside and swept a little bit of internal buy-side liquidity, right? This was what that chart looked like. So end of November, typically bullish. We saw that play out to the T. Of course, I'm aware of our news each and every week. So if we have something like FOMC or some other sort of hyper volatile news event, that sort of affects it. But generally, news will only accelerate what price is already doing. But what I want to tell you guys about is, you know, in all of my analysis, you'll see me mention things like 2 up or 2 down or inside bars. What does this refer to? This is a price action sort of methodology called the Strat, S-T-R-A-T. If you've been around with me for a while, you've likely come across me teaching this before, but all it is identifying candle types. And this is actually something I use primarily in forming bias, right? So a 2 up, anytime I say 2 up or 2 down, just understand there's 3 candle types, okay? Number 1 is an inside bar. I think we all understand what an inside bar is. I'll do my best to find one on this weekly chart. Here's an inside bar, okay? An inside bar is just that. It stays within the last candle's highs and lows. So this candle here didn't break the last candle's high or low. That's an inside bar, easy to understand. So a 1 is always an inside bar. Like I said, there's 3 candle types. So that's a 1. Number 2 is a directional bar. So 2 up refers to a candle that broke the last candle's high and only the last candle's high, right? So a candle like this that we just referred to on the weekly, right? This candle here broke the prior candle's high. This is a 2 because it's directional, and it's an up because it broke the last candle's high. This is a 2 up, just like the candle before it, right? This candle here is also a 2 up because it broke the last candle's high, right? It didn't break the last candle's low. It only broke the last candle's high. These are just ways of identifying the sort of price action we're seeing on a candle by candle basis. So 2 up, vice versa. 2 down just refers to any candle that broke the prior bar's low. So this is, you know, this bar's low. As you can see, we broke that on this candle, right? We didn't break its high, only its low. This is a 2 down, again, directional down. So candle number 1, inside bar. Candle number 2 is directional, can be up or down, 2 up or down. Then candle number 3 is an outside bar. Many of you guys have heard of outside bars. They're engulfing bars, and they simply go outside of the prior candle's range, both the high and the low. So this candle's high and low were broken on this candle here. This candle, this bullish candle, is an outside bar. Easy to understand, right? So 1s are easy to understand, 3s are easy to understand, inside and outside. 2s are just those directional bars that either break a high or a low. Not a high and a low, just a high or a low. So anytime I'm, you know, prepping my weekly or daily biases and you see me say something like this, where previous week closed as strong 2 up in force, all that means is we had a close like this. So we closed as a strong, as in fairly close to our highs, 2 up because we broke this last candle's high, and then in force just means the actual close of this candle was above that candle's high. So let's say, we don't close in force. That would just mean we did break that last candle's high, but we didn't close above it. So let me find an example of that. Okay, so here's an example of a 2-up that is not in force. This candle here, this bullish candle. As you can see, we broke the prior bar's high, but we didn't close above it, so it's not in force. It is still a 2-up because it went directionally above the last candle, but it's not in force because it didn't break that high. Got it? Now compare that with this candle here, which not only broke the last candle's high, but closed above that high. This is a 2-up in force. So all of this ties in together, right? When I make this weekly bias and I say previous week closed as strong 2-up in force, that is hyper bullish, right? This just adds to my long bias for the next weekly candle, right? That in conjunction with my weekly seasonality, this is end of November again, being bullish further strengthens that bullish bias. And then from there, I'm generally establishing a draw. Once I have my bias, okay, that's one thing. Now, where do I think the market is being drawn toward? Weekly highs and lows are generally daily swing highs and swing lows. So if we mark out this high here, then we drop to a daily. Well, this was a swing high. Okay, so this daily swing high was a weekly high here. That was my draw for this week, right? So if we remove this weekly candle like this, and I'm prepping my weekly bias, I'm saying, okay, where is the market headed? Well, we had a really strong close. We closed as a 2-up in force. Seasonality is bullish. What's my draw? Well, the next weekly high is right here. This is a daily swing high, so this is a valid buy-side liquidity target. And then, of course, what happened this week opened up and took out that high, right? So that's weekly bias playing out in real time. Now, if we break that down to a daily and see how that actually panned out on a day-by-day course, you'll see that this was that Monday of that week. Monday manipulated lower. We did close as a bearish outside bar, actually. So this was manipulation and accumulation all on Monday, right? After that, I'm expecting that upside distribution, right? Especially after Tuesday's close, we reverse all of Monday. We begin drawing up to our draw, which we ended up hitting on Friday, right? That's a perfect example of that weekly profile playing out, seasonality coming into play, directional closes, liquidity, all of these various factors being used to give us those biases, right? So, when it comes to our actual trading on, let's say, Monday, well, I'm going to be expecting some accumulation, some manipulation, so I'm not really concrete in my bias. I'll take shorts, I'll take longs, provided that we have good entries and proper context. But then as the week plays out, I'm going to be favoring longs. If we see strong bullish trends like this on intraday timeframes, we see retracements, let's say into a 15 or 5-minute FVG, and then inversions back up, this is a very high probability long. Why is that? Well, the daily candle wants to continue expanding higher and higher. So I understand that retracements are to be bought, right? Once we get our inversion. I'm not necessarily looking for shorts the first chance I get, because more than likely we're not going to be making new lows on the day if we have all of that higher time frame bullish narrative. Guys, I hope this has been helpful. This is episode 9. Again, higher time frame analysis, context, narrative, all of that stuff just helps you be more confident in the market, right? If you understand how the weekly candle, how the daily candle are likely to expand, and you apply all of those concepts down to the lower time frames, right, and use those fractal skills, just gives you a little bit of a sharper edge. Now we all understand 15, 5-minute, but these higher time frames truly do provide you just with a bit more direction. So if you guys are enjoying this series, please leave a like, share it with someone you think it would help. Give me some feedback in the comments. Further episodes to come, we're going to be, breaking down how to use Tradevate, how to journal, different psychology tips, and, kind of getting into the more nitty and gritty technical analysis. I hope you guys have enjoyed it, and I will see you in episode 10.